Welcome to your deep dive on understanding the financial markets. You've given us some really interesting stuff from an Inner Circle Trader training video.
Yeah.
We're pretty excited to unpack it with you. It seems like it gets into some pretty advanced stuff. And, it's clear that you're really serious about taking your trading to the next level.
For sure. The video, it's really all about how to look at market moves sort of in a new way. Like it suggests there's this algorithm and it's powered by AI that is like basically setting the prices for currencies.
Okay, wait a minute. An algorithm? You're saying it's not like traders making these decisions anymore?
Well, the video argues that while human traders, they're still out there, their impact is kind of fading. It's like this AI-powered algorithm, or algo as they call it. It's really like the big player now. And it makes these decisions based on some super complex rules like calculations.
Wow, that's kind of mind-blowing.
Yeah.
So how do we even begin to understand this algo thing? Like, can we use it to our advantage? It almost feels like we're trying to, I don't know, crack the code of the matrix or something.
Right. The video, it gives us this way of understanding the market through this algo.
Okay.
And it lays out these 4 like market conditions that kind of show how the algo is influencing the price action, they call them. Expansion, retracement, reversal, and then consolidation.
All right, so let's break those down one by one. I'm picturing like a candlestick chart here. What would expansion look like if we were looking at a chart?
Okay, imagine you see this sudden long green candle, like breaking through a resistance level. That's expansion happening.
Oh, I see.
It's this quick, strong price movement that signals, the algo is pushing the price in a very specific direction. They call these impulse moves in the video.
Got it.
And they indicate what the algo wants to do with the market.
So it's not just some like random price spike. Yeah. It's like a deliberate move by this algo.
Right, exactly.
But then what happens? Does the price just like keep shooting up forever?
Not necessarily. That's where retracement comes in. Imagine that same green candle, but now like a shorter red candle forms, pulling the price back just a little. That's a retracement, a partial pullback.
Interesting. So why would the algo create this pullback after, such a strong move?
Well, the video suggests the algo uses these retracements to like fill in the gaps. It makes sure that all the different price levels within a range are kind of explored. It's like the algo is like meticulously checking things off the list, making sure every single price level has been like tested.
That's a really fascinating way to think about it. So we've got these expansions and retracements. What about reversal? Does that mean the algo is like suddenly changing its mind?
Reversals, they're like dramatic shifts in the price direction. Imagine you've been seeing these higher highs and higher lows.
Okay, sure.
Showing an uptrend.
Yeah.
Then, bam, all of a sudden there's this big red candle, breaks right through a key support level. That could be a reversal.
Okay, that does sound pretty intense. What's the point? Is the algo just trying to mess with traders?
Well, the video talks about this idea of liquidity pools.
Okay.
These are areas where, tons of traders, they've all put their stop loss orders.
Got it.
So by pushing the price to trigger those stops, the algo can, create this cascading effect, this fuel, like a really sharp reversal.
So if we learn about these liquidity pools, we might be able to sort of anticipate where the algo is going to target those stop loss orders.
Yeah.
And maybe even avoid, getting caught in that trap ourselves.
Exactly. It's about seeing the signs, and using them to your advantage.
This is getting really interesting. Okay, so we've talked about expansion, retracement, and reversal.
Right.
What about consolidation? That sounds a bit more chill, like the market's taking a break or something.
Yeah. Consolidation, it's like a period of relative calm,
Okay.
The price, it's moving in this tight range, like it can't make up its mind. Imagine, a bunch of small candlesticks forming this narrow band on the chart. That's consolidation.
So is the algo like taking a nap or something during these consolidation periods?
No, not at all. The video, it suggests that during these times, the algo is quietly accumulating orders. It's building up like pressure for the next big move. Like it's like winding up a spring. The tighter it gets, the more explosive the breakout could be.
Okay, so consolidation is not just, a boring sideways market.
Right.
It's like a crucial phase.
Yeah.
We should be paying attention because it gives us hints about what the algo might do next.
Exactly.
Okay, this is starting to all make sense.
By by understanding these four conditions through, like, the eyes of the algo, we can start to anticipate these price moves more effectively.
Okay.
But, it's not enough to just know the concepts. We need to actually, like, spot these conditions on a chart, and translate them into, like, actual trading decisions.
That's a great point. So how do we actually, like, see these conditions in real time? Like, use them to our advantage, make some money.
Right. The video, it talks about these specific ICT tools,
Right.
like order blocks, for example. They might help with that.
Okay, wait, before we jump into the tools, I'm a little curious about something. You mentioned earlier that the algo wants to create efficient markets, but wouldn't this whole, like, stop loss hunting thing actually create inefficiency and volatility?
That's a great question. The video, it doesn't really address this directly, but it does sort of suggest that maybe the algo is operating on, like, multiple levels. Maybe creating short-term volatility, even with things like stop-loss hunting, could actually serve a larger purpose, like maybe to maintain overall market efficiency in the long run.
Hmm. That's a really interesting thought. Like, the algo is playing this multi-dimensional chess game,
Right.
and we're just starting to maybe, like, glimpse the board.
Yeah.
Okay, so tell me more about these order blocks.
Okay. So order blocks, they're essentially price levels where, like, big institutions who are probably, plugged into this algo have placed, like, significant buy or sell orders. The video kind of suggests these order blocks act like, footprints of the algo's activity.
So it's like we're peeking into the playbook of these big players.
Yeah.
Trying to, figure out their next move.
Yeah.
But how do we actually spot these order blocks on a chart? Are they like giant flashing neon signs?
No, it's more subtle than that. What you're looking for is a specific pattern, a sharp price movement, followed by either consolidation or a retracement. And the order block is usually within that consolidation or retracement zone, right before that initial, like, sharp move happens.
Okay, I think I'm starting to visualize it.
Yeah.
So we're not just looking at any random consolidation.
Right.
It has to be one that follows, like, a really strong, decisive move.
Exactly. That sharp move, it's often the clue that an institution, maybe guided by the algo, has stepped in.
Okay.
And the consolidation or retracement that comes after, that's where they might be accumulating more orders, getting ready for the next push.
Wow, that's really insightful. So once we spot a potential order block, how do we, like, actually use it to, make trading decisions?
Well, it's not as simple as just, buying or selling whenever the price touches an order block.
Right.
You have to combine, like, order block identification with, other technical analysis tools, confirming signals. For example, if you see, a bullish engulfing candlestick pattern, like near a bullish order block,
Right.
that might be a really strong signal to enter a long trade.
So order blocks, they're like one piece of the puzzle.
Yes.
And we got to fit them together with other indicators and the price action to get the whole picture.
Exactly. And you also have to remember that not all order blocks are going to lead to, like, winning trades.
Right.
Sometimes, the market might just move right through them without any, like, significant reaction.
But by understanding this concept, we're adding, like, another layer of insight to our analysis.
Exactly.
Okay, that makes sense.
Yep.
Now, the video also talks about these liquidity gaps and voids.
Mm-hmm.
I'm having trouble visualizing those. What do they look like on a chart? And why are they important?
Okay, imagine you're looking at a chart. And then, boom, there's this empty space, like the price has just jumped or plunged without trading at any of the levels in between.
Okay.
That's a liquidity gap or void. They usually happen during like fast news-driven moves or during times of, like, extreme volatility.
So it's like the market, like, skipped a beat.
Yeah.
Left behind this blank spot.
Yeah, exactly. And the interesting thing is that the market often comes back to these gaps, these voids, almost like it's trying to, like, fill in the missing pieces.
Okay, that makes sense. But why would the market bother to, go back and fill these gaps? Is it just like a neatness thing?
Well, the videos suggest that these gaps and voids, they represent areas where there wasn't much trading activity.
Okay.
So there's this imbalance in the market structure. And the algo, always striving for efficiency, it might be programmed to revisit these areas just to kind of, restore equilibrium.
That is That is fascinating. So if we can identify these liquidity gaps and voids, we might be able to anticipate where the price is going to go next.
Exactly. One way to approach it is to look for the price to get close to the gap or void area,
Okay.
and then watch for like confirmation signals, like candlestick patterns, or momentum indicators, things that suggest a potential reversal.
So we're not just blindly buying or selling at the gap.
Right.
We're waiting for the market to show us that it's actually interested in filling that void.
Yes.
Okay. Okay. This is starting to click for me.
Yeah.
All right. So we've talked about order blocks and liquidity gaps and voids. The video also talks about liquidity pools. What are those exactly? And how are they different from the gaps and voids?
Okay, so liquidity pools, they're areas where you have these large clusters of stop-loss orders.
Sure.
Think about those classic support and resistance levels, the points where the price has, like, bounced off in the past.
Right.
That's where lots of traders put their stops.
Hoping to, protect their capital if the price breaks through.
So it's like these liquidity pools are like magnets for stop-loss orders.
Exactly. And the video, it kind of suggests that the algo, being as smart as it is, might be aware of these liquidity pools
Okay.
and could, potentially exploit them.
Hold on a minute. Are you saying that the algo might be intentionally, like, targeting these areas where traders have, clustered their stop-loss orders? That sounds almost predatory.
I know, right?
Oh.
It's a controversial idea, and it's definitely not officially confirmed.
Yeah, okay.
But if you think about the market through this lens of, this all-powerful algo,
Right.
it's definitely something to consider.
Okay, that's a little unsettling.
Right.
But it also kind of makes sense in a way. So how do we avoid getting caught in these stop-loss traps? The key is to be, aware of these liquidity pools and to place your stocks more strategically. Don't put them at those obvious levels, like right below a swing low or just above a swing high. Consider, putting your stops further away from these obvious areas. It makes it harder for the algo to target them.
So it's about being a bit more creative.
Yeah.
And unpredictable with our stop placement, not just like following the textbook rules.
Yeah. And remember, it's not just about avoiding getting stopped out.
Right.
It's about understanding that these liquidity pools can also create like really powerful trading opportunities. If you can, anticipate where the algo might be going after those stops,
Yes.
you can potentially, position yourself to profit from the move that follows.
This is all starting to feel like a high-stakes game of chess, with the algo. Okay, we've talked about order blocks, liquidity gaps and voids, and liquidity pools.
Yeah.
The video also mentions this concept of equilibrium. What is that, and how does it fit into this whole framework?
Okay, so equilibrium in this context, it refers to the balance between like buying pressure and selling pressure in the market.
Okay.
It's the price level where, neither the buyers nor the sellers have a clear advantage.
So it's like the market is taking a deep breath,
Yeah.
trying to figure out what to do next.
Exactly. And the video, it suggests that these equilibrium zones, they're crucial for understanding the algo's, intentions. They might represent areas where the algo is accumulating orders,
Okay.
like getting ready for the next big move.
Okay, I'm picturing a chart again. So how do we actually, see these equilibrium zones? What should we be looking for?
Okay, look for areas where the price has been consolidating or ranging,
Okay.
within a relatively tight band. It's like the market is taking a break. It's digesting, the recent price action. It's building energy for the next move.
So it's not just any consolidation.
Right.
It's like a very specific type that suggests, there's this balance of power going on.
Exactly. And within these equilibrium zones, that's where we can start to look for, potential trading setups as the market tries to figure out its new direction.
Okay, that makes sense. So how do we actually trade these equilibrium zones? Do we just buy or sell whenever the price enters the zone?
It's a little more nuanced than that.
Oh, wait.
One approach is to wait for the price to break out of the equilibrium zone, decisively,
Okay.
and then enter a trade in the direction of that breakout. But you got to be careful of those false breakouts.
False breakouts. You mean when the price breaks out and then it just quickly reverses back into the zone.
Exactly. That's why it's so important to combine, equilibrium zone identification with other technical analysis tools.
Yep.
Price action confirmation, Look for strong volume along with the breakout, candlestick patterns that confirm the move,
Sure.
other signals, that suggest the breakout is the real deal.
Okay, this is all starting to like come together. So we're using these equilibrium zones like potential launching pads.
Yes.
But we're waiting for confirmation before we jump on board.
Precisely. And by understanding this idea of equilibrium and how the algo might be using these zones, we can potentially position ourselves for some really, really great trades.
Wow. This has been a mind-blowing deep dive so far. We've covered so much.
Yeah.
The four market conditions, order blocks, liquidity gaps and voids, liquidity pools, and now equilibrium. It feels like we've unlocked like a secret language of the market.
It's amazing, isn't it? And we're really just scratching the surface. Remember, these are just the building blocks. The real magic happens when you take this knowledge and you integrate it into your own unique trading style.
That's what I'm most excited about, like taking all this and actually, applying it to my own trading. But before we go any further, there's this one thing that keeps like nagging at me. We keep talking about this algo as if it's like this all-knowing, all-powerful thing. But is it really possible that an algorithm could influence like everything in the market?
Right.
Even
Yeah.
down to like the types of candlesticks that we see on the chart.
It's definitely a wild thought, but it's something to think about. If we accept that this algo is designed to make markets efficient, then maybe it is also like shaping the very tools that we use to analyze those markets.
Whoa. So we're not just trying to read the market, we're trying to like read the mind of the algo that's creating the market.
It's almost like a game of cat and mouse.
Right.
And it just highlights, how important it is to be flexible, to keep refining how we approach trading.
You know what? This whole thing reminds me of that scene in The Matrix where Morpheus is teaching Neo about the nature of reality.
Oh.
He says like, what is real? How do you define real?
Right.
Feels like we're questioning the very nature of the market itself.
That's a great analogy. We're starting to see like the matrix of the market, the
Yeah.
code behind everything. And the more we understand that code, the better we'll be at navigating it.
This is getting deep.
Mhm.
But I love it. Okay, let's shift gears a little bit. The video also talks about predicting market tops and bottoms,
Mm-hmm.
which seems like the holy grail of trading. Is it actually possible to pinpoint those turning points?
Predicting tops and bottoms perfectly, that's a tough one. But it's not totally impossible. By understanding the things that usually contribute to these big turning points,
Right.
we can improve our chances of catching those big moves.
So it's not about like having a crystal ball or something. It's about developing a framework for recognizing those those crucial shifts in sentiment and momentum.
Yes, exactly. It's about understanding the signs, the patterns, the forces that usually come before those major market reversals.
Okay, I'm intrigued. So what are some of the key factors that contribute to market tops and bottoms?
Well, tops and bottoms usually happen because of a bunch of things coming together, shifts in, investor sentiment, changes in economic fundamentals, technical breakdowns, and sometimes just like crazy valuations. It's like a perfect storm of events that creates those big turning points.
So it's not just like one thing.
Right.
It's a combination of factors that kind of create those big shifts.
Exactly.
Okay, let's break down those factors one by one.
Okay.
First, let's talk about investor sentiment. How can we kind of figure out the mood of the market and see those potential shifts coming?
Investor sentiment, it's a powerful force. When investors are, super bullish, super optimistic,
Yeah.
it can create this feeling of euphoria,
Right.
of excess. And that often leads to market tops.
Okay.
On the other hand, when investors are extremely bearish, pessimistic,
Yeah.
it can create this atmosphere of fear, of panic.
Right.
And that often leads to market bottoms.
So it's about recognizing those like extremes in sentiment, understanding that too much greed, or too much fear
Yes.
can signal that a turning point might be coming.
Precisely. And there are tools, indicators that can help us kind of gauge this market sentiment. Things like sentiment surveys, put call ratios,
Right.
the VIX volatility
So
index.
by tracking those indicators,
Yeah.
we can get a sense of how people are feeling in the market and look for those extremes that might, signal a shift.
Exactly. It's important to remember that sentiment, it can change quickly. We need to vigilant
Yeah.
and adjust our strategies accordingly. We can't just like assume that a bull market is going to last forever
Right.
or that, a bear market will never end.
That's a good point.
Yeah.
Now let's talk about economic fundamentals. How do they play into market tops and bottoms?
Okay, so economic fundamentals, things like economic growth, inflation, interest rates, corporate earnings,
Mhm.
these things play a critical role in shaping long-term market trends. A healthy economy with, good corporate profits usually supports a bull market,
Yeah.
while, slowdowns in the economy and declining earnings, they can trigger a bear market.
So it's not just about like following the herd,
Right. Yeah.
It's about understanding the underlying like economic engine that's driving the market.
Exactly. By keeping an eye on key economic indicators, reading reports,
Right.
assessing the overall health of the economy,
Okay.
we can gain some insights into those potential turning points.
That makes sense. Now, what about technical breakdowns? How can those patterns on a chart, signal a market top or bottom?
Okay, so technical breakdowns, they happen when the price of an asset breaks, below a key support level
Right.
or above a resistance level. And this is often, accompanied by increased volume and momentum. It's like the market is breaking through like a crucial barrier.
Okay.
And that indicates a potential shift in the balance of power between buyers and sellers.
So it's not just about the price breaking through. It's about the way it breaks through, like with conviction, with force.
Yes, exactly. And by recognizing those technical breakdowns,
Yeah.
we can anticipate, potential market reversals and adjust our positions accordingly.
Okay, that's making sense. Now let's talk about extreme valuations. How do overvalued or undervalued markets contribute to these tops and bottoms?
All right, so extreme valuations, they happen when the price of something gets really detached from its actual underlying value. Overvalued markets, they're often driven by like too much speculation, too much euphoria,
Right.
while undervalued markets, they can reflect like extreme fear, extreme pessimism.
So it's like the market's like emotional pendulum is swinging too far in one direction,
Right.
creating this disconnect between price and value.
Precisely. And while, valuations alone aren't always a surefire indicator of market tops and bottoms, they give us important context.
Okay.
They help us, assess the potential for a reversal.
Okay, this is all starting to come together. So by considering these different factors, we can get a better sense of when a market might be topping out or bottoming out.
Hmm.
But it's still a lot to process. Is there a way to kind of simplify this whole idea of predicting market tops and bottoms?
One way to think about it is like this. Market tops, they're often characterized by, euphoria, complacency, excess, while market bottoms are marked by fear,
Oh,
panic,
yeah.
capitulation.
So it's not just about the numbers, it's about the emotions driving those numbers.
Exactly. And when you start to see those extreme emotions playing out in the market, whether it's through news headlines,
Yeah.
social media, or even just, in your own trading circle, that's when a potential turning point might be close.
That's a really powerful insight. Okay, we've covered a lot of ground here. The algo, market cycles, predicting tops and bottoms. It feels like we've been on like this whirlwind tour of the market's inner workings.
Hmm.
But before we get, too carried away with all this knowledge, I
Yeah.
want to bring us back down to earth for a minute.
Okay.
What about the practicalities of trading? How do we manage risk? How do we protect our capital in this complex and often, unpredictable market?
That's a great question, and it brings us to the crucial topic of risk management.
Okay.
Risk management is the art and science of protecting our money from the inevitable drawdowns, the uncertainties that just come trading.
So it's not about like eliminating risk altogether,
Right.
Because that's impossible. It's about managing risk intelligently.
Exactly. Risk, it's a part of trading. And if we try to, completely avoid it,
Yeah.
we're probably going to miss out on a lot of good opportunities. The key is to find a balance, between risk and reward, taking, calculated risks that fit with our goals and our tolerance for risk.
That makes sense. So what are some of the key principles, the techniques that traders use for risk management?
One of the most important ones is position sizing. That's how much capital we allocate to each individual trade. By carefully controlling our position size, we can limit the potential losses on any single trade.
Okay.
And protect our account from those big, catastrophic blowups.
So it's like we're diversifying our risk
Yeah,
across multiple trades, like not putting all our eggs in one basket.
precisely. Another crucial tool is the stop loss order.
Ah, yes.
Yeah.
The trusty stop loss. I've heard a lot about those. Remind me again, how do those work?
Okay, a stop loss order is it's an order that automatically exits a trade when the price hits a certain level that you've set beforehand.
Okay.
It's like a safety net for our trades. Helps us limit losses,
Mhm.
and it keeps our emotions from kind of taking over and dictating our decisions.
So it takes the emotion out of, those panic-inducing moments when a trade is going against us.
Exactly. It's important to remember though that stop loss orders they're not foolproof. They can be triggered by like sudden price spikes or market
Mhm.
manipulation. But they're a really important part of any good risk management plan.
Okay, that makes sense.
Yeah.
Now, are there any other risk management techniques that we should be aware of? What about diversification? I hear that word a lot, in the trading world.
Diversification, it's a key principle of risk management. It's all about spreading our risk across different, asset classes, different
Yeah.
markets, even different trading strategies. By not putting all our eggs in one basket,
Right.
we reduce the impact of any single market event or
Okay.
any trading mistake.
So it's like having a backup plan for our backup plan.
Exactly. Another really helpful strategy is to have a clear trading plan, a roadmap that guides our decisions, helps us stay disciplined, especially when the market gets a little crazy.
Okay, that sounds really crucial. What are some of the elements of a solid trading plan?
A good trading plan, it includes like, predefined rules for entering and exiting trades,
Right.
specific risk management parameters,
Okay.
and even like a strategy for managing your emotions.
Yeah.
It's like having a set of rules to follow. So you're
Right.
not just making decisions on the fly based on, fear or greed.
That's a great analogy. It's like having a playbook for the market, so you're not just reacting to whatever happens.
Precisely. By taking the time to, develop a comprehensive trading plan, to back test your strategies
Right.
and to, practice discipline in your execution, you can really reduce your risk and increase your chances of, long-term success.
This has been a really eye-opening conversation about risk management. It's clear that protecting our capital is just as important as making profits.
I totally agree. Risk management, it's often overlooked,
Yeah.
especially when people are focused on, getting rich quick. But it's really the foundation of any successful, trading career.
Okay, we've covered so much in this deep dive. The algo, market conditions, technical analysis, risk management, and even like the psychology of trading.
Yeah.
I'm feeling a bit overwhelmed, but also like incredibly inspired.
It's a lot to absorb for sure, but remember, trading, it's a journey, not a destination.
Mhm.
And the more we learn, the more we realize there's, even more to learn.
That's both exciting and kind of daunting at the same time. But before we wrap up, I want to touch on one more crucial topic that's often overlooked: money
Sure.
management.
That's a great point. Money management, it's the art and science of handling our trading capital responsibly.
Yeah.
Making sure that our wins are bigger than our losses over
No.
the long term.
So it's not just about making money on individual trades.
Right.
It's about it's about managing your capital in a way that lets you stay in the game
Yes.
for the long haul.
Exactly. The video really emphasizes that money management is just as important as any technical indicator or trading strategy. It even goes so far as to say that bad money management can ruin like even the most skilled trader.
Wow, that's a sobering thought. You could have the best entry and exit signals,
Right.
but if you're risking way too much on each trade, one bad loss could just wipe you out.
That's the truth about trading. It's not about getting rich quickly. It's about building, a sustainable approach, one that lets you, weather the storms and come out ahead in the end.
So how do we actually develop, a solid money management plan? Where do we even begin?
Well, the video it outlines several steps.
Okay.
And the first one is figuring out our risk tolerance.
Risk tolerance. That sounds, I don't know, kind of personal.
It is. It's about understanding, how much of your capital you're really comfortable risking on a single trade.
Right.
What level of drawdown can you handle
Right.
without panicking, without making, emotional decisions.
Yeah, I see how that's really crucial. You don't want to be losing sleep over every single trade,
Right.
or
Yeah.
letting fear control your actions.
Exactly. The video suggests, starting small, maybe even risking as little as like 1% of your capital per trade
Okay.
until you get a feel for, your comfort level.
It sounds like a pretty prudent approach, especially when you're first starting out, Better to be safe than sorry, and gradually increase your risk as
Yeah.
you gain experience, as you gain confidence.
Absolutely.
Yeah.
Once you have a good understanding of your risk tolerance, the next step is to figure out your position size for each trade.
Position sizing. That sounds a little, I don't know, technical.
It's really just it's just calculating how many, units of an asset you're going to buy or sell
Right.
based on your risk percentage that you decided on and the stop loss level for the trade. And make sure that even if your stop loss gets triggered, the
Yeah.
loss is only a small percentage of your total capital.
Okay, I think I'm starting to see how this works. It's like a built-in safety mechanism that prevents any single trade from like blowing up your account.
Exactly. The video even recommends, calculating your position size before you even enter a trade.
Okay,
So you're not letting emotions get in the way.
that makes a lot of sense. You don't want to be messing around with calculations
Right.
when you're in the heat of the moment and maybe making impulsive decisions.
Exactly. It's all about creating this systematic approach
Yeah.
to trading,
Yeah.
where your decisions are based on, logic, predefined rules,
Yes.
and not emotional reactions.
Okay, so besides position sizing, are there any other money management strategies that the video highlights?
Yeah, another key strategy is setting, realistic profit targets
Okay.
and
Yeah.
stop loss levels for each trade. This helps you define your risk reward ratio, making sure that the potential profits justify the risk you're taking on.
It sounds like that goes, hand in hand with position sizing. You're not just like randomly placing your stops and targets. You're really thinking about it.
Right.
You're calculating them strategically based on your risk tolerance and your overall, trading plan.
Precisely. The video really stresses that every single trade should have like a predefined exit strategy, both for locking in profits
Yeah.
and for limiting those potential losses.
So you're not letting greed or fear
Right.
dictate your exits. You're sticking to the plan and letting the market do its thing.
Exactly. The video, it even suggests this technique called scaling out of winning positions.
Okay.
Where you gradually take profits as the price moves in your favor. It reduces your risk
Okay.
and it lets you lock in gains, along the way.
That sounds like a really smart way to manage those winning trades and protect your profits from those sudden reversals.
It's about playing the long game. Understanding that consistency and capital preservation, they're really the keys to sustainable success.
This has been an incredibly insightful deep dive. We've explored so much: the mysterious algo, the intricacies of market conditions, technical analysis, and now the critical importance of risk and money management.
Mhm.
I feel like a whole new world of trading knowledge has opened up to me.
It's a journey,
Yeah.
of continuous learning and discovery. The market's always evolving,
Mm.
and so should our understanding of it.
But I'm also feeling, I don't know, a little overwhelmed by all this information.
Right.
There's so much to absorb and actually put into practice.
It's totally natural to feel that way. The key is to break it down into, smaller steps and focus on mastering one concept at a time.
So it's not about trying to, learn everything all at once.
Right.
It's about taking a strategic approach, a step-by-step approach to building your knowledge and
Right.
your skills as a trader.
Exactly. The video, it encourages viewers to start small.
Yeah.
Focus on, one market condition, one technical indicator, one money management strategy at a
Okay.
time, and gradually build your understanding and your expertise.
That's really encouraging advice. It makes this whole journey seem, less daunting, more achievable.
It's all about taking, ownership of your trading journey. Don't just, blindly follow signals or gurus.
Right.
Understand the why behind every decision you make.
So it's about becoming an independent trader
Hmm.
who can think for themselves, make informed decisions
Yes.
based on their own analysis and understanding of the market.
Oh, precisely. And remember, trading, it's a marathon,
Yeah.
not a sprint. There are going to be ups and downs, wins and losses.
Right.
The key is to stay disciplined,
Okay.
manage your risk,
Mhm.
and never stop learning, never stop adapting.
That's a great message to end on. This deep dive has really given me a whole new perspective on trading, and I'm excited to start, putting this knowledge into practice one step at a time.
That's the spirit. Remember, the journey of 1,000 miles begins with a single step, and,
Hmm.
and the market, it's waiting for those who are willing to take that first step and embark on the path of mastery.
This has been a fantastic conversation. Thank you for joining us on this deep dive into the world of trading.
Yeah.
We hope you've gained some valuable insights that you can apply to your own trading journey.
It's been a pleasure sharing this journey with you. Remember, the markets, they're always changing, so stay curious, stay disciplined, and
Mhm.
and never stop seeking knowledge.
Until next time, happy trading.
It's the art and science of handling our trading capital responsibly. Making sure that our wins are bigger than our losses over the long term.
Okay, so it's not just about, making money on individual trades. It's about managing your capital in a way that lets you stay in the game for the long haul.
Exactly. The video really emphasizes that money management is just as important as any technical indicator or trading strategy. It even goes so far as to say that bad money management can ruin like even the most skilled trader.
Wow, that's a sobering thought.
Yeah.
You could have the best entry and exit signals, but if you're risking way too much on each trade, one bad loss could just wipe you out.
That's the truth about trading. It's not about getting rich quickly. It's about building, a sustainable approach, one that lets you, weather the storms and come out ahead in the end.
So how do we actually develop, you know, a solid money management plan? Where do we even begin?
Well, the video, it outlines several steps, and the first one is figuring out our risk tolerance.
Risk tolerance. That sounds, I don't know, kind of personal.
It is. It's about understanding, how much of your capital you're really comfortable risking on a single trade. What level of drawdown can you handle without panicking, without making, emotional decisions?
Yeah, I see how that's really crucial. You don't want to be losing sleep over every single trade
Yeah.
or letting fear control your actions.
Exactly. The video suggests, starting small,
Yeah.
maybe even risking as little as like 1% of your capital per trade until you get a feel for, your comfort level.
That sounds like a pretty prudent approach,
Hmm.
especially when you're first starting out. Better to be safe than sorry and gradually increase your risk as you gain experience, as you gain confidence.
Absolutely. Once you have a good understanding of your risk tolerance, the next step is to figure out your position size for each trade.
Position sizing. That sounds a little, I don't know, technical.
It's really just it's just calculating how many, units of an asset you're going to buy or sell based on your risk percentage that you decided on and the stop loss level for the trade, it makes sure that even if your stop loss gets triggered, you know the loss is only a small percentage of your total capital.
Okay. I think I'm starting to see how this works. It's like a built-in safety mechanism that prevents any single trade from like blowing up your account.
Exactly. The video even recommends, calculating your position size before you even enter a trade, so you're not letting emotions get in the way.
That makes a lot of sense. You don't want to be, messing around with calculations when you're in the heat of the moment and maybe making impulsive decisions.
Exactly. It's all about creating this systematic approach to trading where your decisions are based on, logic, predefined rules and not emotional reactions.
Okay, so besides position sizing, are there any other money management strategies that the video highlights?
Yeah, another key strategy is setting, realistic profit targets and stop loss levels for each trade. This helps you define your risk reward ratio, making sure that the potential profits justify the risk you're taking on.
It sounds like that goes, hand in hand with position sizing. You're not just like randomly placing your stops and targets. You're really thinking about it. You're calculating them strategically based on your risk tolerance and your overall, trading plan.
Precisely. The video really stresses that every single trade should have like a predefined exit strategy, both for locking in profits and for limiting those potential losses.
So you're not letting greed or fear dictate your exits. You're sticking to the plan and letting the market do its thing.
Exactly. The video, it even suggests this technique called scaling out of winning positions. When you gradually take profits as the price moves in your favor, it reduces your risk and it lets you lock in gains, along the way.
That sounds like a really smart way to manage those winning trades and protect your profits from those sudden reversals.
It's about playing the long game. Understanding that consistency and capital preservation, they're really the keys to sustainable success.
This has been an incredibly insightful deep dive. We've explored so much. The mysterious algo, the intricacies of market conditions, technical analysis, and now the critical importance of risk and money management. I feel like a whole new world of trading knowledge has opened up to me.
It's a journey, of continuous learning and discovery. The market is always evolving, and so should our understanding of it.
That's true. But I'm also feeling, I don't know, a little overwhelmed by all this information. There's so much to absorb and to actually put into practice.
It's totally natural to feel that way. The key is to break it down into, smaller steps and focus on mastering one concept at a time.
So it's not about trying to, learn everything all at once. It's about taking a strategic approach, a step-by-step approach to building your knowledge and your skills as a trader.
Exactly. The video, it encourages viewers to start small, focus on, one market condition, one technical indicator, one money management strategy at a time, and gradually build your understanding and your expertise.
That's really encouraging advice. It makes this whole journey seem, less daunting, more achievable.
It's all about taking, ownership of your trading journey. Don't just, blindly follow signals or gurus. Understand the why behind every decision you make.
So it's about becoming an independent trader who can think for themselves, make informed decisions based on their own analysis and understanding of the market.
Precisely. And remember, trading, it's a marathon, not a sprint. There are going to be ups and downs, wins and losses. The key is to stay disciplined, manage your risk, and never stop learning, never stop adapting.
That's great advice. This whole deep dive has really given me a whole new perspective on trading. I'm excited to start putting all this knowledge into practice, one step at a time.
That's the spirit. Remember, the journey of 1,000 miles begins with a single step. And the market, it's waiting for those who are willing to take that first step and embark on the path to mastery.
This has been an amazing conversation. Thank you. Thank you for joining us on this deep dive into the world of trading. We hope you've gained some valuable insights that you can use on your own trading journey. And remember, the markets are always changing, so stay curious, stay disciplined, and never stop seeking knowledge. Until next time, happy trading.